Tableside Talk. My name is Cam Kelly. I'm a commercial real estate broker with the Langert Commercial Group, and to my right is Evan Langert.
Hi everyone, as Cam said, I'm Evan Langert. I am the principal and founder of the Langert Commercial Group. We're a full-service commercial real estate brokerage and advisory firm serving all of Maryland, DC, and Northern Virginia and beyond. And today we're going to talk to you about...
Rising interest rates.
Yes they are.
So Evan, the news has been filled with interest rates increasing.
Mm-hmm.
I was hoping that you would be able to speak to how the increase in interest rates, in addition to the increase in vacancy in some commercial real estate properties, might affect building owners.
Sure. So typically when you go out and you buy a shopping center, an office building, a hotel, or warehouse, what have you, you'll get a loan from a lender, unless you're a cash buyer, obviously, and you'll have to qualify. They'll lend you a certain amount of the value of the building. That's called the loan to value. Oftentimes you'd have to put 30% down, 35% down. Depends on what kind of loan you're getting, depends on what kind of property that you're buying. SBA programs, you put a lot less down. And then they have other parameters that you have to meet. One is called a debt service coverage, and that looks at the rents that are coming in minus the expenses, and it says, well, how many times can you cover the debt with that amount? Is it, just once? And if you lose one tenant, well, you can't quite cover the debt, or is it 1.2 or something along that line? So you take a snapshot of when the loan's made. A lot of loans can be 5, 7, 10 years, but they're amortized over a longer period of time, so your payments are lower. So a loan might be amortized such that it was a 25-year loan. In other words, your payments are based as if it was a 25-year loan, but it's not a 25-year loan. The amortization is 25 years. The loan is, say, 10 years. So it comes due in 10 years, and you still have a bunch of money left that you haven't paid because the amortization was so much higher. And then it comes time for the loan needs to be renewed, whether you renew it at that bank, whether you refinance it elsewhere. Sometimes you get caught a little short. Times get bad. You've lost some tenants. Recently a lot of vacancy rates. I'll just look at office properties, places where they were 7, 8%, 9%, 10% vacancies can now be 20, 22% vacant, 25% vacant. Interest rates have gone up quite a bit. It was just, I think, the past week that the Fed raised them another quarter of a point. And I understand there's another increase, maybe 2, that are supposed to be coming. So you get to the end of that, whether it's 5 years or 10 years, you get to the end of that loan, and the bank may have changed because the economy is different. The bank might say, you know what, we're not doing loans with 30% down anymore. We're requiring 45 or 50%. Or maybe we're not even making loans on those types of properties anymore. And so you look at that, and then you look and say, well, we were 10% vacant, now we're 20% vacant, and so we don't meet the debt service coverage ratio anymore. And sometimes banks do not renew the loans, and you can't find a place to refinance. And so there are a lot of people that come out and they're like, it's setting up, it's going to be carnage. We, the cash buyers, are sitting out there and we're going to get a bunch of properties for 50 cents on the dollar. And there is some of that in some of these cycles. I've been around for a lot of them in 35 plus years. And there have been a couple of situations or a couple of cycles where it's gotten pretty bad out there. But, banks, they don't want an REO, what's real estate owned portfolio. They're in the business of lending and making money off the loans. They're not managers of properties and things along that line. So we've had people, and this came up because we just had somebody who was kind of yelling that there's going to be blood in the streets. And my response was maybe a little bit, not so much if history's any guide. Because when loans start to go bad, if the bank just crosses its arms and says, yeah, you owe us $2.5 million, we're not renewing your loan, pay up, and you don't have the $2.5 million, what's the bank going to do? They've got a $2.5 million loan. They do have fiduciary relationships to their depositors. They can't just write off every loan that's due. And so what tends to happen in those periods of time is they have loan workout groups, and those people work with building owners to see what they can do to restructure or do whatever's necessary to make the ending come out more positive for both parties. However, in these cycles, there inevitably is some level of distress. There are loans that just will not get picked up again. There will be people that can't afford their properties, can't afford to repay the loans. And so there are likely to be some distressed properties that hit the market. I am cautious. A lot of people are, they're just big on the superlatives, blood in the streets and all that sort of stuff. And I've just been around long enough where, it didn't really happen. Look at COVID. I was told half of every restaurant is going to close. I read stuff like that in the trade magazines. Buildings, nobody's ever going to go back to work, and office buildings are a thing of the past, and they're not. Still, I'm thinking of downtown Bethesda off the top of my head because I'm working on a couple of things there. Their vacancy rates are between 20 and 22%, and part of that's been caused by some new large buildings that have come on board there. So it's not just a clean measure that says, well, vacancy rates have fallen by that much, but 20%, especially given what they're 23%, especially given the fact that some of that's due to new supply on the market. That's not the blood in the streets that people called for. They were talking about half empty or all empty office buildings, and 50% of all restaurants going out. So a lot of people love hype, and similarly, they're talking about blood in the streets here with interest rates rising, with loans coming due. And I think there will be some of that. It remains to be seen how much, how deep the discounts will be, and how many of those loans get worked out. But it is a thing, as people say, and it is something to pay attention to. Might provide some investment opportunities if you are an investor, and you can come up with significant down payments or cash, something along that line. It is something to watch out for if you're a building owner at this particular time. So that's about it. I tend to give a pretty even-handed review of these things because you can't, absent a crystal ball, you can't always tell how a cycle is going to turn out. Hope that's helpful. Cam and I are always here to try to give you any information we can based on our collective experience. I think we calculated that between the two of us, we've lived in Maryland, DC area, Baltimore area for, was it somewhere between 60 and 70 years?
On the higher end of that range.
Yeah, the higher end of that range. And I alone have been, again, in this industry for over 35 years. So we've been through a lot. We'd love to advise you on your particular situation and answer any questions that you have. Give us a call, give us an email. Have a great day. Bye.